the two hosts of another YouTube show. By the way, I am not disclosing their names just because I don't want to name any names. And as far as I'm concerned, we are all in this together. We are all one community and we are all one family. However, my strategies, my view of the markets, my experience in the markets, my methods are very different to others out there. I always say, blaze your own trail, interpret data differently to everybody else. So, anyway, these two hosts of another YouTube show are convinced that there is no real bull run happening or possible until still active stimulus liquidity is sufficiently drained. Point number one. Two, no bull run until we reach unemployment pain and the S&P gets crushed to around 3,000 and risk assets, including Bitcoin, capitulate dramatically. And number three, and that 2% inflation is Jerome Powell's white whale. He'd rather wreck the economy than chance lingering inflation. What say you from Not Michael Burry? I love this question, and let me just explain again, not naming any names, how I see the market. First of all, the definition of a bull run. Let's jump into the beginning. Make sure we address every single point because this is a bit of a very deep question. There is no one definition of a bull run, but typically it's considered to be a period of at least 20% price appreciation. And for crypto, you've heard me say this before, I double it to 40%. So once you get off the bottom and you're 20% off the bottom in equities, it's a bull run. In crypto, you got to be 40% off the bottom to be a bull run. And I believe we are 8 months at least into the early Bitcoin bull run. No doubt about that. So could be wrong. There could be a nasty black swan that could kill us all like World War III, and then I'm wrong. But as long as things chug along the way they are, this is a bloody great bull run. Next, no real bull run is happening or possible until still active stimulus liquidity is sufficiently drained. So first of all, it's very important. This run is not driven by the US markets. Maybe US equities are, but crypto definitely not. And this run is not driven by retail stimmy checks. So it's very different. I believe this run is driven by Asia. It's driven by institutional buying. And it's also broad-based. People are stacking all over the world. And that's very clear from on-chain. I spend an inordinate amount of time every single day looking at on-chain analytics. Next, let's look at Bitcoin. So Bitcoin did shoot up 101% in 234 days. That is not a bull run. That is 2.5 times a bull run using my 40% off the bottom metric. Okay. So again, over 100%, 234 days. Pretty good. It has dipped a little bit down, as you can see here from the chart. But if you're waiting for things to crash, no, especially after such crazy returns. But it gets better. There's more. No bull run until we reach unemployment pain. The S&P gets crushed to 3,000 points, and risk assets, including Bitcoin, capitulate dramatically. Again, this run is not defined by retail, in my opinion. Many live paycheck to paycheck. They don't have the type of money to move the markets anyway. Second, and I've done many videos about this, the labor market is structurally different since 2020. And I can show you 100 charts to point to that. A lot of people quit, retired, early resignation, quiet quitting, etc. There's so much change. A lot of people have 3 jobs, etc. Very different. And the stock market is now nudging 4,600, way off of 3,000. A dip to 3,000 would mean basically a 35% fall. I don't see that unless there is World War III, like I mentioned before. And the host thesis, who will remain nameless, said also that the S&P 500 would be flat for a decade. That's already proven to be false. And other things like gold would be the best performing asset. You know, gold is garbage. I always said that from day one. Let's look at this one. Is kind of important because there are elements of the labor market versus the soft landing that we need to dig into, and it gets a little bit tricky here. So since you did mention crushing labor, yes, well, you know my thoughts on that. I do believe high-paying jobs are being replaced by lower-paying ones, and I believe many people have 3 jobs. For example, I know a person who is a personal trainer in the morning, works at a coffee shop until 4 p.m., and then drives Uber Eats at night. 3 jobs, 1 person. Okay. Now, this is where it gets tricky. So what we're looking at here is kind of If you imagine the Beveridge curve, this is a curve that shows the relationship between the number of job openings and the unemployment rate. And the Phillips curve is a curve that shows the relationship between inflation and unemployment. When you mash them both together, there is a way out. And I explain why. The unemployment rate is low right now. And there are lots of job openings, but they're all crappy minimum wage jobs. There's no like $250,000 salary jobs out there. Very rare, very few and far between. But that means, though, if some of these job openings do close, it won't cause a big increase in unemployment. Additionally, if inflation, as it is right now, it can weather a small increase in unemployment, which could help kind of bring it down too. And people aren't demanding kind of high salaries, etc., work from home, all that stuff. So this is kind of tricky, but taken together, the two fitted curves clarify a potential, although not guaranteed, of a soft landing for the economy. Let's talk about the S&P 500 for a sec. So it's a very deep question, so it requires a lot of explanation. This is pretty amazing. In January 2023, my S&P target for year end, that was December 2023, was 4686, again published. And people called me Hopium Boy. Well, we're 6% away from that target. 6% after a 31% run. So, are we going to 3,000? No. And the 2% inflation, this is interesting. I do believe, the 2% is something that is kind of a white whale. We agree on that. But the soft landing is possible. Remember, a lot of people kind of have gig economy type jobs. But the soft landing is possible. Earnings expectations were in the toilet for big businesses, but now it's easy to beat. So the stocks are up and the market is crushing earnings expectations. And finally, as I've always said, JP does not control inflation. All right. If a supply chain breaks, which he does not control, prices go up. If the system is flooded with cash from money printing, prices go up. If OPEC cut production, oil prices goes up, which drives inflation up, etc., etc. He doesn't control those key factors that drive inflation, but he does destroy demand. That's what he can do. And he's making it very painful now for commercial real estate, for banks, etc. So we kind of sort of agree on the last piece, but let's just look at some performance off the bottom of some crypto assets, because I'm talking about the S&P 500 and crypto, etc. But look at these numbers from the Crypto Compendium. Does this look like a bear market to you? Injective up 605%. Render up 530%. Lido 378%. Optimism 268%. Solana 202%. The Graph 115%. Ethereum 107%. That's from 6/18/2022. It has the current cycle low. That's a model that we actually build into our model to determine exactly when the kind of bottom was for certain assets. Bitcoin, 11/21/2022. By the way, it's interesting to see how ETH and Bitcoin had different lows at different times. That's kind of rare for it to be so far off, nearly 6 months apart. But you can see 87%. Chainlink is 55%. And I threw in Cardano there as well, because according to my definition, it's not in a bull run yet, because it needs to be 40%. And it's only 30% off the cycle low from 10th of June. So that is the view of the world. I do not agree with the other group. So hope that helps.